from July to August, the average sale price, average median home value on those sales went down $5,000. That's fairly significant month over month, in my opinion. When I used to drive through these cities, houses would go up on the market and literally within 24, 48 hours, it would have contract pending or sold or whatever the case may be. Now, as I'm driving past those same listings, I'm seeing them sit on the market substantially longer. And when I say substantially, as opposed to 1 or 2 days, it might be 1 or 2 weeks now, which doesn't sound like a heck of a lot, but that certainly indicates that the market is really starting to loosen up. Welcome to the VIP Financial Education YouTube channel, where we help you go further, faster financially. I'm your host, Michael Mathe. Guys, excited about the video today. We're going to keep it fairly brief here, but love bringing real estate videos into the fray with you guys. That's a major component in my professional background, so love doing the research on your behalf. Obviously, I'm an avid reader and researcher in real estate in general, and love sharing the information with you. So if you want us to continue to bring real estate videos here on the channel, go ahead and smash that thumbs up button below. That helps out our algorithms and obviously lets us know that you want more information just like this. So I've got some data here from a report released by Realtor.com. In August, prices actually have started to quasi-normalize from a year-over-year and even a month-over-month perspective. More houses coming on the market, which, one of the biggest reasons why the pricing has gone through the roof has been a deficiency in supply. Obviously, we've had that pent-up demand, we've had the demand, but the supply has not been there. As more houses are coming into the market, obviously that's going to help adjust that pricing back down to normal levels. Here's what Realtor.com said. New listings ticked up 4.3% year over year in August, although inventory was down 25.8% compared to the same time in 2020, the data showed. That's an improvement compared to July, however, when inventory was down 33.5% annually. Just from July to August, there was an 8% in increased inventory, which is a very promising sign, obviously, for housing prices to start adjusting. In addition, asking prices did not rise as quickly in August. The median listing price registered an 8.6 year-over-year price increase in August to $380,000, down from July's record price of $385,000, the report found. However, it's also nearly 20% more than August 2019. Guys, 2019, it really hadn't blown up yet, so I don't know. I kind of take that with a grain of salt, but I think that that's a very telling stat that from July to August, the average sale price, average median home value on those sales went down $5,000. That's fairly significant month over month, in my opinion. They went on to say, low mortgage rates have motivated buyers to endure this year's challenging market, and now some buyers are starting to see their persistency pay off. Sellers also began adjusting listing prices to better compete with an uptick in inventory. It's a strong seller's market, she continues, with homes selling quickly at record high prices, but now a home priced well and in good condition may see 2 or 3 bids compared to 10 last year. For sellers not seeing as many offers, it may be worth revisiting pricing strategies as buyers continue searching for homes that fit their budget. Now, that's pretty interesting. So one of the reasons, obviously, pricing got out of control is if you've got 10 or 20 or 30 or 40 plus buyers bidding on a particular property, obviously that's going to drive the pricing up. Fewer bidders, it's going to keep that pricing really in check. It's going to really keep those sellers in check. They know that they're going to have their house in better condition. Buyers are going to start requesting contingencies, which has almost been on pause here over the last 18 months. In order to get these houses, these buyers have had to come in many cases, all cash, at list or above list with 0 contingencies. Well, that can get you in hot water really quickly. So what I'm hearing out there on the streets, if you will, is that buyer contingencies are starting to become a little bit more normalized at this point. And even though you would still definitely consider it a seller's market, some of this data is showing that the buyers are finally starting to take back some of their leverage. Another thing that I'm noticing here, and I spend the vast majority of my time in really 3 cities, Oklahoma City, Dallas, Texas, and Jacksonville, Florida. So just being in those cities frequently, and obviously, I have my reticular activator, which means when something is on your radar, you're seeing it all the time, whether it's a car, a particular type of house, shoes, whatever the case may be. I see it with houses for sale, days on market, and I can calculate in my head when I used to drive through these cities, houses would go up on the market, and literally within 24, 48 hours, it would have contract pending or sold or whatever the case may be. Now, as I'm driving past those same listings, I'm seeing them sit on the market substantially longer. And when I say substantially, as opposed to 1 or 2 days, it might be 1 or 2 weeks now, which doesn't sound like a heck of a lot, but that certainly indicates that the market is really starting to loosen up. So be cognizant of that in your area. Your normal driving patterns, I'm sure you're driving by houses for sale all the time. Kind of take a mental note when you're seeing those as you're driving by them, and just check in with them every couple days and see, what kind of activity is on there. Are they sold? Are they, have a contract pending at that point, or are they sitting on the market longer? As an investor, keep following these trends, of course. You're not out there as an investor buying in the retail market, but what I'm keeping my eye on as an investor, obviously, are going to be the forbearances and the moratoriums lifting. So as the forbearances lift, obviously that is going to generate some spiraling of distressed houses, whether they're going into foreclosure. What I'm going to be keeping an eye on are going to be the pre-341s, notice of defaults. Those are going to happen over time after these forbearances lift. Effectively means that people are going to be behind on their payments. They're in a little bit more of a distressed situation, and you can come in there as an investor, help them out, of course, because a lot of these people just want to get out from under the mortgage, or they just want to have their debt serviced, or they just want to walk away completely. So there's going to definitely be some low-hanging fruit there. With the moratoriums being lifted, obviously landlords have been destroyed during this. So moratoriums have done really nothing to help out tired landlords or landlords in general. So a lot of them are going to be coming out of this literally exhausted. They've got a sour taste in their mouth at this point. Contacting these folks, whether you meet them through a local RIA, do your own networking, but finding these tired landlords is certainly going to be a boon for you if you want to build up your portfolio. So as an investor, that's really what I'm looking at. So what I feel this kind of cool down, if you will, in many markets is going to do is create this secondary wave of buyers. So there was this first initial huge wave that really bumped the prices up. It's obviously been a frenzy here over the last 12 to 18 months. But the secondary wave of buyer are going to be, folks that either didn't even get in the fray because they really didn't want to get into those bidding wars. They didn't want to pay at the top of the market, and or people that were in the mix. They were putting offers in. They were going out there and hustling. And unfortunately, for one reason or another, or potentially fortunately, sometimes missing out on a deal is the best thing that can happen to you if you're looking at it down the road and kind of through that different lens after the fact. But this cooling down is going to bring those people back off the sidelines. The people that are in one of those two scenarios that are now feeling a little bit more empowered to go out there and maybe make an offer that is maybe less than list or at list, but certainly not above list. They're looking at potentially bringing contingencies back in right now. I mean, over the last year or so, those contingencies have almost been completely removed. Things like appraisals, things like inspections, just normal standard house buying 101 contingencies or contingent on financing, all of those things that are just have been standard in real estate over the last, since I've been in it, have been kind of a thing in the past because people didn't want those roadblocks when there were 25 other people looking at getting the same property. So definitely seeing a lifting on that. This is encouraging for buyers, so continue to keep your eyes and ears open on that. But contingencies might come back into play here. Just more reasonable housing, more reasonable pricing on this. Sellers are obviously seeing that they can't, just shoot for the moon anymore in many of these markets. And now let's dive into some data and a report from Redfin. So according to Redfin, the median price of homes sold in August was $380,271. Like I said, up 16% from a year earlier, but that's the lowest growth rate since February. August did mark the 13th consecutive month of double-digit price gains. And according to Chief Economist Daryl Fairweather at Redfin, when it comes to home prices in the market, what goes up stays up. That's especially true in the Sun Belt, for example. Home prices are up more than 20% from the last year in August in Austin and Phoenix. Even with these steep increases, homes in these areas are still relatively affordable. So these and other hot migration destinations are going to continue to attract home buyers from the coasts. As workers change jobs en masse and enhanced unemployment benefits come to an end, we could see even more households relocate for affordability in the coming months. So I think that that's very telling as well. Obviously, Redfin is an authority out there that I like to really follow closely, so I would definitely stick close to data that they put out there. You know, there are so many tie-ins with just the housing market in general and just what's going on with the economy right now. In my opinion, these are really unprecedented times. So again, what we can do is go out there and do this data research on your behalf, but we're going to continue to do videos. Drop the thumbs up below if you want to hear more videos specifically on real estate. We've got some inflation videos coming up. We've got interest rate videos coming up, talking about unemployment benefits lifting, talking about moratoriums and forbearances lifting, and how all of these are really intertwined. So we're going to continue to bring videos like this. If you guys, give us that feedback, obviously drop comments below. If you are not a subscriber, go ahead and subscribe. We're always looking for new like-minded people here on the channel, and hit that bell notification below if you want to get alerts as we're bringing additional content like this on the VIP Financial Education YouTube channel, one of the most sought after and trusted channels on YouTube, talking about all things credit, capital, and cash flow. Until next time, guys, thanks for joining us and make it a great day.